What built the most powerful financial center in the world? It wasn't just innovation. It wasn't just trade. It was a business model so brutal, so efficient, that its dividends are still being paid today. The London Stock Exchange, a global symbol of civilized capitalism, has deep historical links to an economy that perfected the capitalization of human beings. The bankers, who later traded shares in railways and canals, first perfected their methods by underwriting the sale of men, women, and children. They created a financial system that could insure, collateralize, and securitize human life. But this isn't just a history lesson about a barbaric past. The same logic, the mechanism of turning unseen suffering into sterile profit, is embedded in the global economy right now. That same pattern of securitizing the unseen is active today in complex supply chains and opaque investments that underpin the global economy. By the end of this video, we will explore two critical analytical frameworks derived from this dark past: asset rehumanization and capital flow auditing, frameworks for identifying the real risks hidden inside the systems we all rely on.
This is Finance Beyond Seas. We explore the moments where the currents of maritime history and the tides of the global economy collide. We're here to navigate the wreckage of the past, to find the financial lessons that will protect you today. We analyze history and systems, not futures. Nothing presented here is financial advice. It is purely historical and economic commentary.
To understand the scale, you must first understand the machine. In the 18th century, Britain was rising. It needed to fuel its new consumer appetites: sugar for tea, cotton for textiles. This required a massive, continuous, and cheap labor force in the Americas. The triangular trade was the devastatingly logical answer. Phase 1, the outward journey. Ships left ports like Liverpool, Bristol, and London, loaded with manufactured goods, guns, textiles, copper, and trinkets. They sailed to the West African coast. Phase 2, the Middle Passage. Those goods were exchanged for enslaved human beings. Captains packed their ships far beyond capacity, treating people as cargo. This was the journey of unimaginable horror. Phase 3, the return. The survivors were sold in the Americas. The ships were then loaded with the products of their forced labor, sugar, cotton, and tobacco, and sailed back to London, generating enormous profits. But this machine had a critical vulnerability: risk. A ship could sink in a storm. A revolt could break out. A captain could die. How could a merchant dare to fund a voyage that might never return? This is where finance provided its most chilling innovation. In a small coffee house in London, run by Edward Lloyd, merchants and ship captains gathered. They wouldn't fund an entire voyage themselves. Instead, they would underwrite it. A merchant would write his name under the ship's manifest, accepting a fraction of the risk for a fraction of the potential profit. This was the birth of Lloyd's of London, the world's most famous insurance market. This act of placing a precise, cold financial value on a human life, insuring it as cargo, feels like a distant horror. But it's the exact same logic that led to the 2008 financial crisis. Bundling subprime mortgages, obscuring the true risk, a family's home, inside a complex financial product, a CDO that no one truly understood. This mechanism of obscuring the true asset is why we will later explore the asset rehumanization strategy. But first, the system had to prove its brutality. In 1781, this system was tested. The slave ship Zong was nearing the end of its voyage, but it was running low on drinking water. The captain made a calculated financial decision. He ordered 133 enslaved Africans to be thrown overboard, alive, to drown in the Atlantic. Why? Because if the slaves died of natural causes on board, it was the ship owner's loss. But if they were jettisoned to save the rest of the cargo, the insurers at Lloyd's of London would have to pay the claim.
The case that followed wasn't for murder. It was an insurance dispute. The court debated only one thing: were these people cargo? The micro lesson: the system had become so financially abstract that it created a moral hazard so profound it literally incentivized mass murder for a payout. But it wasn't just insurance that was built on this trade. It was the banking system itself. How did a plantation owner in Jamaica buy enslaved people? He used credit. And who extended that credit? The rising banks in London. It was standard practice for prominent London bankers to take Jamaican plantations, including the enslaved people on it, as collateral for debts. Banks advanced massive loans to planters and ship captains, using human beings as the asset backing the loan. The insurance, Lloyd's, mitigated the risk, the banking houses of London provided the liquid capital, and the London Stock Exchange was where the profits from these ventures were reinvested and multiplied. The common theme is the financial alchemy of turning an amoral and illiquid asset, a human being, into a liquid and respectable financial instrument, an insurance policy, a bank loan, a company stock. This capital, laundered by finance, became the fuel for the entire Industrial Revolution. The most telling financial detail of this entire era isn't just its beginning, but its end. When Britain finally abolished slavery in 1833, the government faced a financial crisis, not from the 800,000 people who had been freed, but from their owners. The slave owners demanded compensation for their loss of property, and the government paid. They took out a massive loan of £20 million. That was 40% of the entire UK government's annual budget at the time. It was one of the largest government bailouts in history. And who received this money? The masters, not the slaves. This debt was so enormous that British taxpayers were still paying it off until 2015. Think about that. The financial legacy of slavery, a bailout for the owners, was woven into the fabric of the British economy for 180 years. The pattern was complete. The system protected the capital even after the asset itself was declared illegal. The profits were privatized, the moral debt was socialized. Fast forward to today, the iron chains are gone, but the financial chains are not. The model of profiting from distant, opaque suffering is the engine of 21st century globalization.
Look at the smartphone in your hand. The cobalt in its battery was likely mined in the Democratic Republic of Congo. Investigations have repeatedly shown this industry is rife with child labor and lethal, unregulated conditions. Miners, often children, dig in tunnels with their bare hands for pennies. Look at fast fashion. That $10 shirt. Its price is only possible because it passes through a long, obscured supply chain, often ending in factories in places like Bangladesh or Vietnam, where workers face poverty wages and unsafe buildings. The 18th century banker in London just saw cargo on a ledger, not the person in the hall of the Zong. Today, the investor, and even the CEO, sees a ticker symbol, a quarterly report, or a Tier 3 supplier on a spreadsheet. They don't see the child in the mine or the worker in the collapsing factory. Do you see the pattern? Whether it's an insurance policy on a slave ship or an ESG rating on a tech stock that ignores its cobalt source, the mechanism is identical: distance and abstraction. The technology has changed, but the financial logic of insulating capital from human cost is the same. This is why the lesson of capital flow auditing, tracing the source of the profit, is now a critical analytical tool. We will explore that lesson in a moment. The modern triangular trade is this: cheap, often exploitative labor from developing nations creates cheap goods, which are consumed by developed nations, generating massive profits for global corporations, which are traded on the London, New York, and Shanghai stock exchanges. The pattern is clear. The profit is in the opacity. What does this pattern mean for the modern economy? We might think modern corporations are clean. We see trusted blue-chip brands and assume their value is built on solid ground. But what are those operations actually built on? They are participating in a system that still profits from distance and abstraction. Here is the systemic risk. That abstraction is fragile. The 1833 Abolition Act was a regulatory shock that vaporized an entire asset class and cost the government 40% of its budget. Today's shock could be a new supply chain law that suddenly holds corporations liable for the labor in their suppliers. It could be a carbon tax that renders entire business models obsolete. It could be a consumer boycott fueled by social media that destroys a brand's reputation overnight because its dark route was exposed. A corporation whose profit model relies on this opacity is not resilient. It is concentrated in one single massive risk, the risk of transparency. From a systemic view, that corporation is holding the modern equivalent of a Zong insurance policy.
Its value is based on an abstraction that could fail, revealing the true, fragile asset beneath. So what lessons can we draw from this history to understand modern risk? This is not about specific actions. It is about changing how we see the systems we participate in. The past provides a map to identify fragility. The lesson of asset rehumanization. This lesson comes directly from the Zong Massacre. The financial system that viewed people as cargo was built on a lie. When that lie was legally challenged, even in the wrong way, the entire model became unstable. The historical insight, a system that fundamentally misrepresents its core asset, is inherently fragile. The rehumanization framework is an analytical tool. It moves beyond asking, what is the yield, to ask, what is the true underlying asset? Is a company's profit built on a brand people love, or does it depend on an opaque, dark route of exploitation? A modern middle passage that could be shut down by a single piece of legislation or a shift in public opinion. An economic model built on a transparent and stable human foundation is, by definition, less exposed to the regulatory shock that destroyed the slave economy. The lesson of capital flow auditing. This lesson comes from the 1833 bailout. The wealth from the slave trade was washed by reinvesting it in legitimate industries, hiding its origin. But the origin remained the source of the initial wealth. The historical insight is a tool for tracing the source. It poses the analytical question: where does the real profit come from? Is a company's high profit margin the result of true innovation, or does it depend on an opaque, dark route of exploitation, a modern middle passage that could be shut down by a single piece of legislation or a shift in public opinion? This is not about cynicism. This is about resilience. It's about recognizing the true ballast of the ship you are on, using the wreckage of the past as our guide. The route from the shores of Africa to the floors of the London Stock Exchange was paved with human bones, but legitimized by insurance policies, bank loans, and stock certificates. The past is never dead. It's not even past, but we often misunderstand that phrase. It doesn't mean we are doomed to repeat it. It means we are still living inside its consequences. The financial architecture it built is the house we all live in. The currents of finance are powerful, and they always seek the path of least resistance, flowing toward maximum profit, often through the darkest channels. Do not be passive cargo on this journey. Be the navigator. Question the manifest. Understand the ballast. Only by understanding this architecture can we navigate its consequences and chart a more resilient path forward. If this look into our financial past gave you a new map for the present, subscribe to Finance Beyond Seas. We are here to chart these hidden routes. What invisible modern supply chain worries you the most? Let us know in the comments below.